It's official. Silicon Valley Bank has finally found a buyer, First Citizens Bank. First Citizens is based in North Carolina, and it calls itself the nation's largest family-controlled bank. It'll get SVB's $72 billion loan portfolio at a roughly 20% discount. It'll take over all of SVB's remaining $56 billion in deposits, and it'll also get a $35 billion line of credit from the FDIC to cover potential future losses. However, the FDIC will retain the long-term treasuries that sparked SVB's decline. Shares in First Citizens surged more than 50% after the news. So, Scott, the first time we discussed SVB, you predicted that a bank would come in and take it over, and the depositors would be safe. That appears to have all happened. Did it go down in the way that you expected?
I thought it was going to be a big bank that would want entree into the venture world. This was two regional banks making one bigger regional bank. The learning here is that one of the things about investing is that, well, there's two things. First is, of all the asset classes or all of the different parts of the life cycle investing, there's seed, venture, growth, public growth, mature, value, and then distressed. I have found on a risk-adjusted basis, the best place to invest is distressed. And it comes down to one thing, that you really need to be careful not to trust your instincts. And occasionally you want to, when your instincts are really strong, you want to pause, try and put your emotion, your instincts aside, and think the other way. Develop a thesis that zags while everyone else is zigging, because humans will do almost anything to avoid pain. And when we come off the weekend where shareholders lost all of their money in SVB, you think that must have hurt. I don't want to have that. I don't want to endure that kind of pain. And so the entire sector starts getting pummeled. And you immediately think, wow, I hate this sector. This whole sector's in trouble. It's probably my instincts are to short the sector or to sell my banking stocks. Mm-hmm. And that might be right. But at a minimum, you want to slow down and go, okay, instincts are rooted or cemented in us or implanted in our DNA over millions of years. And the way they get implanted is that they are the common emotion across the majority of the species. And that is, you are scared of fire, and so is the majority of your species. Yep. And when everyone's running, when your first instinct is, I need to run from all bank stocks, you need to recognize that that instinct is probably prevalent across the majority of investors right now. Now, what does that mean? It means everyone's a seller. And when everyone's a seller, it means that decent companies that'll survive this mess get unfairly punished. They're the babies that get thrown out with the bathwater. So First Citizens is an example of that. And that is, this is a company that is basically built on the backs of failed banks. They've done this 11 times. They go to a failed bank and they say to the FDIC, they say, Dad, will you pay for this? Will you put me in business and you absorb all of the downside because you're dad and you have more money than me, but I'll give you some of the upside. Mm-hmm. They've done this 11 times. And as evidenced by the terms here, basically, they're saying, here, you take the shitty, dangerous, explosive assets that have long-term maturities on them. I'll take the other assets. And basically, you'll backstop me, finance the acquisition, and all I have to do is give you a portion of the upside. It's as if, say I finance you to buy a Chick-fil-A, and you didn't have to come out of pocket for it, and you became the manager and managed it, and you just had to give me a small percentage of the upside. It's just a great deal. And First Citizens has not only made great money over time, banks generally aren't that volatile. Upon the close of this deal, First Citizens shares went up 50%. That is enormous. So the lesson here is that when you see something on fire, everyone's instinct is to run. But as an investor, you want to immediately check your instincts and go, should I be running into the fire? There will be some regional banks here, some niche regional banks that have a great business, that have not experienced a run, that have not experienced large outflows, but their stock is off 30, 40, 50%. That's where the opportunity is. Your instincts and your emotions are your enemies around investing.
On another note, so we were talking about First Republic last week, and First Republic stock rose around 11% after the government said it would help any more struggling banks. It would provide further assistance. It feels like maybe, I mean, it's still way down compared to the beginning of the year, but it feels like maybe the contagion is subsiding. Has it?
That's what it feels like. It's just not on the news. I mean, CNBC feels like they're trying to keep it alive. I turned on CNBC for a moment this morning. You know, media loves to catastrophize because it keeps you glued to your TV screen or to your smartphone. But it doesn't feel. I haven't heard of any other banks going down. I mean, the kind of stress testing circled the globe. It forced Credit Suisse into the hands of UBS. But I haven't seen any kind of DEFCON 4 on any other regional banks. Just the notion that SVB, which is arguably the most hated bank in the world right now because it has the term Silicon Valley in it, the depositors there got backstopped 100 cents on the dollar. So I don't think depositors are that scared. Even with all the catastrophizing on CNBC, I think they say, well, if they bailed out those douchebags in the Valley, they're going to bail out us in Kansas if something goes wrong at First Kansas. Mm-hmm. So it feels like this is, in fact, calming down, that we're, I mean, quite frankly, the best thing that could happen to regional banks right now is some other catastrophe in the news. And unfortunately, there's so many mass shootings that we seem numb to that. I mean, that just kind of happens every day. And the shooting that just took place in Tennessee, that diverts our attention for what is a tragically small amount of time because there's just so many of them. If that had happened here in the UK, and I'm going off script here, but there was a mass shooting in Dunblane, Scotland, and 16 kids and 2 adults were killed. Tragic. It happened in 1997. And immediately the citizens of the United Kingdom said, well, this is intolerable. We just can't have this. And so they passed several laws around the possession of firearms and handguns, the types of weapons you could own, the need for registration. And since 1997, in 26 years, there hasn't been a single school shooting in the United Kingdom. We've had 13 so far this year in the United States. So anyways, a bit of a digression, but this is when people throw up their arms in the United States and say that there's no way we can solve this problem with a problem that is uniquely American, that just makes no fucking sense. This is the most tragic thing about gun deaths in the United States, whether it's school shootings, whether it's suicides, is that we know exactly how to fix this. But because we have minority rule, because of the NRA, we have been overrun by money and by far-right Republicans who see votes in just having this sort of staunch anti-government absolutism, extremism around guns. But the majority of Americans want some form of gun control. And this is the most fixable, unnecessary cause of death, disease, and disability that has existed in the United States. It's really gross. Anyways, back to what we were talking about here. This thing will be officially kind of over once there's something else that occupies the business headlines. Because if there was going to be a run on these things, it probably happened last week, and it feels like all of them had the liquidity to withstand those withdrawals.
How do you think history is going to remember this? Because specifically from a political perspective, I was watching a Trump's interview with Sean Hannity, and Hannity asked him about this Silicon Valley Bank situation. It's already become a political issue, and Trump's response was, the government dealt with this terribly. It was so awful. I wouldn't have bailed them out. This was a big government bailout. I mean, sort of stuff that you would expect. Do you think people will buy that? One, I assume you just completely disagree, but how will people look back on this, say, at the debates next year?
Oh, look, Biden could save puppies, and Trump and DeSantis would find a reason. I mean, until recently, DeSantis was saying our support of Ukraine was a bad idea. And then when he realized that was a really stupid thing to say, he's trying to walk it back now. But Trump would have bailed this pink out in a moment. I mean, the moment his Treasury Secretary walked in and said, okay, you might be the president that inspires a banking crisis, he would have, he bailed out with, in all caps, the economy during the novel coronavirus. So I don't think, I think almost any president with the full, with full information would have just said, okay, I can either risk a collapse in the banking system and the dollar and financial panic, or I can come in and spend whatever it is, $24 billion to bail these guys out. I don't think this is going to be much of I think this will be a trivia question.
Yeah.
I think, we've argued before, or we've said before, I think Senator Warren, when she says banking should be a boring business, be careful what you ask for, because then it might become a boring business and the economy becomes boring. You want a limited number of ring-fence bank failures because you want sort of some leverage in the system. Otherwise, we could do away with defaults on mortgage bonds by just demanding 80% equity for any loan. We'll loan you 20%, not 80%. And then what happens? Housing prices crash and young people such as yourself can never own a home. And that's how it is in a lot of nations. There isn't available credit. So a certain amount of leverage, a certain amount of bank failure that's ring-fenced, again, sign of a healthy economy. I think we look back on this more as just the color around it. There'll be a Netflix documentary, maybe an original scripted program starring Jared Leto or, I don't know, Anne Hathaway or somebody. We'll see. Who would be good? Who would play
You'd be
Greg
good. It's
Becker?
a bald guy.
Greg's a bald guy?
Yeah.
I like it. I like it.
Let's get Kelly O'Coin back.
Load up on bonds. Everything's fine. Don't panic. Don't panic. As he's sweating and popping Xanax.
And selling.
Yeah, and selling. On the other hand, hold on a second. It's my broker. Sell, bitch, sell. Yeah, I could absolutely be that guy. I'm going to Hawaii. He pieced out to Hawaii. That guy has I would argue he doesn't have great judgment. Anyways, I don't think this is what I'd call a historic financial event. I think it's a trivia question in a year.
Yeah. And I just want to end on this final point, which is, so this transaction will cost the FDIC $20 billion. All of that will be covered by the fees that the FDIC charged the banks. In other words, taxpayers haven't paid a penny on this. And it feels like no one's actually lost money. So I guess the conclusion would be this turned out completely fine. But famous last words, we'll see what happens to the rest of the banking sector.
But it's just an important point. The FDIC is a separate off-balance sheet insurance entity that charges fees to banks to cover bank runs like this. And now you could argue that every depositor is going to have to indirectly pay for this because the insurance that the bank is going to be charged for FDIC insurance is probably going to go up. But I think they have $120 billion in that reserve fund or in that insurance fund. They're asking the big banks to put in more. And I think their logic is the big banks are going to be the ones that benefit most from this because there'll be a flight of capital or a leaking of capital from small and regional banks to the big guys. The big guys will push back and say, well, why are we paying for the sins of these little banks? But the FDIC, think about this. This was the most expensive bank failure, I think, in history.
Yep.
And it took out, 18% of the insurance company's funds. And the reason why you have insurance is such that when there's a disaster, the insurance company comes in and makes everyone whole.
Yeah. Yeah, to me, this is a giant victory for the banking system. It's like we built this whole system in anticipation of this event. It happened, and then we fixed it. So I think it's a good way to conclude.
Good for us. Good for the banking system.